What's going on, you guys? My name is Zach Hartley, and in this video, we are going to compare the TFSA and the RRSP. We're going to break them down so that you can figure out which one is the best fit for you. Here is everything you need to know. Let's go. Okay, so let's just jump right into it and ask ourselves, why should you even consider either of these options? Well, the number one reason and the main thing that you want to consider here is the tax advantages associated with each one. Now, the TFSA stands for Tax-Free Savings Account, and the RRSP stands for Registered Retirement Savings Plan. They have a couple of big differences, so let's dive into the TFSA first. The TFSA is designed to help you invest your post-tax money and pay no capital gains tax. So what I mean by this is, let's say you make $50,000 a year at your job and you pay about $10,000 in taxes. What the TFSA allows you to do is take that $40,000 that's left over, you can take part of it and put it into a TFSA, and let's say you buy Apple stock with that money. If Apple stock goes from $100 to $500 over the next year or 2 years or 5 years, you pay absolutely no tax on the profit that you make on that investment. That profit is referred to as capital gains, and under the TFSA, there is no capital gains tax, which is absolutely amazing. And so the idea with the TFSA is that once you've generated $50,000 in income, you pay your income tax on it, and you've got your money left over, you can invest that money left over and never have to pay tax on the capital gains that you generate with those investments. That's the advantage of the TFSA, is that you get that tax break after you've paid your income tax. The RRSP is a little bit different because the RRSP allows you to take that same $50,000, but instead of paying income tax on $50,000, it allows you to make a contribution before you pay income tax. So let's say your salary is $50,000, you can contribute $10,000 to your RRSP, and then you can pay income tax on $40,000 that's left over. The advantage here is that you're contributing to this savings account before you pay income tax on it. So if let's say your income tax bracket is around 30%, you've now just added 30% extra into your savings plan, which is so nice, and it's a huge tax advantage here, especially if you're a high income earner. So if you earn $100,000 or $200,000 a year, you're in a very high tax bracket. So if you can bring your yearly income down, you'll pay dramatically less taxes on it, and the more tax you pay, the better the advantage is for the RRSP, and the more incentivized you are to actually contribute to it because you save even more money. Now, when we look at these two different accounts side by side and we compare the advantages, it's very clear that the TFSA gives you the tax advantages once you have that money in your pocket and you decide to invest it. The RRSP allows you to take that money from your employment and basically reduce your income so you pay less taxes on your income, and you can take that chunk and invest it before you pay those taxes. So those are the advantages between the TFSA and the RRSP, but there's a couple of things you need to know. Let's start with the TFSA. The number one thing you need to know is that there is a contribution limit each year. In 2021, it was $6,000. So that for the year of 2021, I can contribute $6,000 into my TFSA. Or if I have any room from prior to that, I can fill up that room. That room started in 2009 if you were 18 years old, or whenever you hit the age of majority, anytime after 2009. So let's say you're in Alberta and you were 18 years old in 2009, your contribution limit in your TFSA is $75,000, which means next year you'll probably be able to add around another $6,000 to it, and that's pretty much what's happened since 2009. So that's really, really cool, but you can't go over that, otherwise you pay a couple of penalties for it. But the nice thing about the TFSA is that you can withdraw that money at any point. So it makes a fantastic emergency fund. It makes a good place to store money for a big purchase or a big trip. It's a fantastic for that because it gives you lots of flexibility there, and you can recontribute next year. So let's say that my contribution limit is $75,000 and I pull out $20,000 this year to go buy a car. Well, the nice thing is that next year I'm probably going to get another roughly $6,000 with the contribution limit back, and I'll be able to refill that $20,000 that I withdrew this year. That date that everything turns over is January 1st. It goes on the calendar year. So when you withdraw and when you contribute definitely matters. Make sure you look into that. The only downside to the TFSA is that if you hold U.S. companies that pay U.S. dividends, you are subject to a 15% U.S. withholding tax. So if you're holding U.S. companies that pay dividends, the TFSA is something that you might want to reconsider, because you will pay 15% tax before you ever see that dividend. It just gets taken straight off. Now, the RRSP still has some things that you need to know about. The rules are slightly different. So your contribution limit, or how much you can actually put in each year, is equal to 18% of what you made the year before. So if you made $100,000 last year and paid income tax on it, you will then be able to contribute $18,000 to your RRSP prior to paying any income tax on that income. So if you make another $100,000 this year, you can contribute up to that full $18,000 to your RRSP before you pay any tax on it, which is really, really nice. You can contribute up to a maximum of $27,830. So that's the maximum kind of 18% from last year's. If it equals $27,830, that's the most amount of money you can put into your RRSP, because they have to limit your tax advantage, because it is pretty good here. Now, you will have to pay taxes on the withdrawals if you withdraw it before retirement. It depends on how much money you take out. The more money you take out, the higher it's taxed. So you need to be careful of that. If you're pulling out $1,000, it's not a big deal. But I think if you pull out $40,000 or $50,000 from your RRSP, the taxes are pretty significant. So you need to be careful there. But the nice thing here is that in the RRSP, your US dividends are not subject to a withholding tax. So you do not have to pay a withholding tax on US dividends, which is really, really nice, especially if that is going to be a big part of your portfolio. And the last thing that is really, really important when it comes to the RRSP is the home buyers plan. Now let's talk about that, but before we do, you need to consider signing up for my stock market course, because this is going to be the best resource you can find for choosing what investments to pick and what stocks to get into when you set up your TFSA or your RRSP. It is a 2-week completely free course. When you sign up for a trial on Skillshare, you get access to the entire platform for 2 weeks. It's a 9-hour course, so if you can do the entire 9 hours in under 2 weeks, cancel your subscription, you get the entire course for free. There's over 2,100 students that have already gone through the course. There's 115 plus reviews for you to read through, and the link is down below in the description. I promise you, it will be the best free resource you can find for figuring out how to fill up your TFSA and your RRSP and actually get going in the market on the right foot. Now, your RRSP home buyers plan. This is what we need to talk about, because this is actually pretty exciting, because it allows you to withdraw up to $35,000 from your RRSP completely tax-free for a basically purchase of a home or a down payment. So what's nice here is you make some money basically from your salary, you contribute to your RRSP before you pay any income tax on it, and then through the home buyers plan, you can withdraw that money and put a down payment on a house, which means you can buy your house or put a down payment down without ever paying tax on that money, which is really, really nice. There are a couple of rules here though. You need to replace that money in your RRSP within 15 years. So if you pull out 35, you need to put 35 back in over the next 15 years. And those funds that are in your RRSP that you withdraw have to have sat in that RRSP for at least 90 days before you withdraw them. But the nice thing is you can combine this with your spouse or your girlfriend or whatever it might be, so that you can both go do this, pull out 35 and then put it down on a house, which is really, really nice. It's a great option. And the nice thing here is that now you can put 35K down on a down payment on a house without paying any income tax on it. You probably just saved at least $10,000 in taxes, and you probably got a nice little tax bill back at the end of the year. So it is a really, really nice plan, and it is well structured if you take advantage of it and you plan ahead and you meet all of the requirements, and you have to plan to refill that money in the next 15 years. But it is a good plan. Now, which one is best for you? Well, we talked about buying a home. If you plan to buy a home and you can take advantage of that plan, probably the RRSP is the best option. However, if you're saving money for an emergency fund or for a big trip or for a car, the TFSA is probably going to be a better option, because you can withdraw that money at any point. The TFSA is probably a better option for short-term saving, whereas the RRSP is probably a better option for your house or for your retirement type savings. It is also a good option for dividend stocks, especially US dividend stocks, because you'll make an extra 15% compared to the TFSA. However, in the TFSA, it is much better for high growth stocks, because if you buy Apple at 100 and it goes to 500, you get to basically reap all of that reward without paying any taxes on it, whereas you will have to pay a little bit of tax in the RRSP when you pull that out. So there is some advantages and drawbacks to each and every one. The RRSP is definitely better for retirement and buying a home and dividend stocks and more long term. TFSA is much better for short term, high growth, lower income. That's the other thing that you need to consider is if you're a lawyer right now and let's say you're articling and you make $60,000 a year, you're better off contributing to your TFSA because you're not paying a ton of income taxes right now. However, in 5 years from now, when you make $300,000 a year, you're going to be paying 45% income tax. And if you can use your RRSP to lower your tax bracket and pay less income taxes, it will be worth more to you then. There will be more advantage of using the RRSP the more money that you make on a yearly basis, because it can lower your income and reduce the amount of income taxes that you have to pay. The TFSA is much better on the other side of it. So if you're lower income, TFSA is better for you. If you're making over 100, or I think it's 96,000 a year in Canada, if you're over that amount, you're probably better in the RRSP trying to lower your incomes. Now, if you're interested in seeing what stocks I am buying and how I'm investing and where I am putting my money, then you need to consider signing up for my Discord chat. That is where I'm trying to build a community of traders to share their research, share their trades, and share their knowledge to help everybody make more money. I share all of my charts as well as my technical analysis and a weekly watch list in that Discord chat. So if you're interested in getting access to that and seeing that so you're not trading or investing at home alone, definitely consider signing up. The link is down in the description below. But realistically, the big summary here is that you need to try and take advantage of the TFSA and the RRSP accounts, because there is massive tax advantages here that can save you a whole lot of money, especially in retirement or buying a house, or if you hit it big in the stock market and you get some stocks with massive capital gains, you won't have to pay any taxes on it, which is absolutely phenomenal, and it's something that you definitely want to take advantage of because it's really, really important. Now, if you get any value out of this video, please remember to click that like and subscribe button. I sincerely appreciate it, and it really helps out my channel, and I will see you guys in the next video. Good luck trading, good luck investing. Talk to you soon.